Facebook. But so we welcome everybody here, as well as the people that are going to watch, hopefully using Facebook Live. Before we start, I'll outline what the format of the meeting is. First of all, there will be a presentation by SaskPower, and I'll introduce them in a moment or two. Following that, there will be an opportunity for questions from the floor or presentations that people may wish to make. And there will, of course, be opportunity for questions after all of the presentations are done. I would also like to note that these proceedings are being recorded and that they will be posted on the panel's website so that you can go back and watch whatever portions of it you may want to. With that, I will turn it over to Scott Comas from SaskPower. Scott is the Director of Planning and Rate Design for SaskPower. And then when Scott is finished, he can introduce the other gentleman who will carry on with some further comments. Scott.
Good afternoon, everybody. So before we begin kind of the formal presentation, and while this is a meeting kind of organized and led by the Rate Review Panel, because it's primarily a SaskPower-led presentation, we've got a bit of a custom that anytime we're meeting with 5 or more individuals, we start that meeting with a safety moment. So the one we've chosen for today is relating to nighttime driving in Saskatchewan. So just a couple of pointers. Use your high beams at night on roads not lit by street lamps. You must dim your headlights at least 200 meters in advance of oncoming vehicles and keep them dim until the vehicle has passed. If you're driving 100 kilometers an hour, that means as a rough ballpark, you should dim your lights when the oncoming vehicle is 8 to 12 seconds away. Keep your headlights on low beam when being passed until the passing vehicle is at least 100 meters away. And then finally, no need to dim headlights on divided highways if roadways are 22 meters or more apart. So with that, I think we'll probably target the presentation will take 40 to 45 minutes, and we're going to break it into 2 different sections. So the first one is I'm going to walk us through kind of a financial overview, hitting some of the topics such as what are we asking for, what has changed since our last rate application, why do we need this rate increase, and then we'll close with just kind of a larger overall financial outlook. I'll then turn it over to Rod McQuarrie, who will kind of walk us through a couple other components of this rate application, including rate rebalancing and rate redesign. Now that is only for demand meters customers. So what are we asking for? So this rate application was launched on Friday, February 18th, and in it, we're looking at 2 rate increases. The first being effective September 1st of 2022, and then another 4% effective April 1st of 2023. What does that mean for our customers? Well, on the residential side, it works out to roughly $5 a month, again based on average consumption, roughly 675 kilowatts per month. And for the average farm customer, it works out to $12 per month. And again, part of this rate application is going to consider both rebalancing and a shift in our rate design. So what's changed since our last application? A number of things. Within the application itself, we've tried to narrow it down to these 3. They are very significant initiatives, the first being the introduction of the federal carbon tax. So that began in 2019, and it is, in a way, separate from what we consider SaskPower rates. It is shown on our individual customer bills, shown as a separate rate rider. The second one is emission reduction requirements. So currently, SaskPower is targeting reducing our emissions by 50% by the year 2030 compared to kind of that start date of 2005. In addition to that target, the federal government has also announced some further targets ultimately resulting in net zero emissions. So we're looking at target dates of 2050 and 2035, and reviewing some of the options we might have to achieving those goals by those dates. And then finally, the impacts of COVID-19. This isn't unique to SaskPower by any means. For individual customers, for small and large businesses throughout the province, COVID has clearly impacted each of us in a number of different ways. So in terms of why were we able to not raise rates since 2018? There's a couple factors that have contributed to that. The first is quite low natural gas pricing environments. In 2018-19, we were looking at what we refer to as the weighted average cost of gas, around $3.22 a gigajoule. When we're looking at today's forecast, it's more than $1.10 per gigajoule higher. Over the last few years, we've also benefited from above average hydroelectric generation. To give just a little bit of context as to what that means, so in 1920, our hydro generation was roughly 6% what we refer to as median or budgeted levels. And that means that we're getting an additional 213 gigawatts of generation coming from our cheapest source of energy. The following year in 21, that increased from 6% to 17% above median assumptions, resulting in 632 gigawatts of additional low-cost generation. Well, this current fiscal year, we're seeing that trend flip, and our hydro generation is 23% below median. Again, doing the math, it means that we're having to find 855 gigawatts of additional generation from more expensive sources, largely natural gas driven. The third thing is on the interest rate side. There's been lots of talk in the news recently, not so much when the Bank of Canada and interest rates around the world are going to start rising. It's now a matter of how soon that's going to be. But that said, and we'll see it in a slide a little bit later, we have benefited from this low interest rate environment over the last number of years. The fourth is through a number of different internal efficiencies. We've had a number of internal programs that have been designed to give targets to each of our business units and for them to look for ways to maintain or reduce where possible, whether it be through business optimization or continuous improvement strategies. We're also continuously looking at our workforce efficiency and looking for ways to make sure that we're aligning our staffing requirements in the most efficient manner. And then finally, and this is something that is being worked upon across the whole Crown sector, is Crown collaboration. And so we are working with the other Crowns just for looking for ways that we can work together to ultimately find further savings and improve our bottom line. So what's driving this rate increase? I'll maybe just start kind of with a description as to what this graph is showing. And it's straight out of a rate application, and it's simply trying to capture, using 2018-19 as a starting point all the way through to the final year of this rate application, which is 23-24, and trying to put in context in terms of our annual expenses, where are we seeing those cost drivers? So starting at the top, the first one is kind of a bucket of expenses that we refer to as our capital-related expenses. The two biggest ones in there are our depreciation, which is driven by how much we're spending on an annual basis on our capital spending. And then the second one is on the interest rate side. And when I mentioned, or on our finance charges, and when I mentioned the favorable interest rate environment, what we have been able to do over the last few years is retire some of the more high interest rate paying debt that we had on our books. Interest rates kind of in the range of 9 to 10%, and we're able to refinance that at rates in the 3 to 3.5% range. So when you're looking at this graph in terms of an expense driver, that's actually going in the good direction. We're seeing those capital-related expenses being about $9 million less than where they were at in 2018-19. The second category, we show it as an acronym, OM&A. That stands for operating, maintenance, administration costs. It's really our people costs. It's SaskPower employees, it's the contractors that we hire, or external consultants. Those are the main contributors to our OM&A spend. You know, on top of that, there's vehicles and tools and you know, a number of other expenses, but it's primarily the operating budget. And so when you're looking at this bar, this is contributing about a $57 million increase in our expenses. And you know, to put into context what are some of those main drivers, it's not so much our business as usual costs or our main core costs. It's more driven by a number of these other initiatives that we are putting extra attention to. I've got a few of them listed on this slide. You know, SMR consortium costs a lot of that in the news recently. This is a relatively new initiative for SaskPower, but over the next couple of years, we're seeing, you know, roughly $15 to $20 million being spent just on doing some of the feasibility work assigned to our small modular reactor program. Vegetation management. This has been a significant area of emphasis, not just for SaskPower, but for utilities across North America. And what that's really dealing with is preventative work in making sure, you know, especially in the northern part of our province where you can have brush that grows underneath our lines, just making sure that we are staying on top of clearing that and making sure that we're mitigating some of the fire issues that might come up. Another one is cloud costs. I laugh because I'm an accountant, and this is really just kind of an accounting change. And it's driven by the fact that in the past, when we would buy IT assets, whether it's, you know, hardware or software or server-based, server-owned or company-owned IT resources, the accounting rules would say we could capitalize that and then amortize it over the life. But as, you know, technology is changing and we begin to move to more of a cloud-based environment, the accounting rules dictate that you need to expense those costs as they occur. So really it's just moving from one bucket to another, but it does stand out when we're kind of focusing in on our operating expenses. So that leaves us with the bottom bar, and that's our fuel and purchase power. You know, two key drivers to that one. The first being an increase in our renewable generation. And, you know, I've got a bit more on that in the following slide. And then the second one, and I alluded to this earlier, we are definitely seeing higher natural gas prices. We really saw that in our year-end numbers for this year. At the time the rate application was prepared, and the way we come up with these estimates looking at the forward curve, we were seeing a bit of a tapering off in those fuel projections. However, the world has changed quite significantly since even the beginning of February, and we will be continuing to monitor, you know, how those much higher gas prices are going to be impacting, you know, our forward-looking statements. So in terms of comparing our generation options, so SaskPower has recently added, you know, approximately 400 megawatts of renewable generation. A lot of that is primarily from wind. Two major wind projects, our Golden South Wind Energy Facility was 200 megawatts, and our Blue Hill Wind Energy Facility was another 175. So when we're introducing wind or solar, most of those renewable generation sources are added through contracts with independent power producers. Now, you know, going back to this previous slide, when we're looking at that big jump in our fuel budget, I just want to kind of clarify that when we look at the accounting treatment for renewables, or specifically these wind IPPs, what's a little bit different than if you were to compare it to, say, natural gas generation, is that when you have a gas plant, you've got obviously the capital cost, the depreciation, the fuel piece, you've got people working it, you've got maintenance costs, and those expenses are kind of differentiated between a number of different expense lines within our income statement. When you've got an IPP, you using these ones as an example, the cost is strictly allocated to fuel and purchase power. So that's one of the reasons why we're seeing that big jump in that fuel cost. The final bullet is just meant for kind of clarification or for informational purposes. So one of the challenges with renewables is the intermittent nature of wind and solar. And what that refers to is that even here in Saskatchewan, where it seems to be windy almost every day, you do have those times where the wind isn't blowing. And so in the case of solar as well, obviously you're limited to the number of daylight hours. So those types of generation are referred to as intermittent. On the other hand, if we have hydroelectric generation, as you can see here, imports from Manitoba Hydro, that is considered more base load, meaning that you're getting kind of that consistent stream of energy that you can rely on at all hours. Electricity demand. So this is another driver behind our need for a rate increase. And there's a few things going on in this slide. So I'm going to start with the blue bars, and you're going to see two shades of blue. So the dark blue, if we start back at 2014 and look to that trend line up through 2018-19, what you can see is relatively consistent growth. On average, it was about 2.6% a year if you were to do the math. When we transitioned into 2019-20, that resulted, or in that year we had about a 2.1% drop in our sales volumes. And when we were kind of looking through the different customer classes or categories in which contributed to this variance, it was largely driven by our power class. Moving forward into 2021, so we had an additional drop of 3%, and that's really our first year of really seeing the impacts of COVID-19 on SaskPower sales. During the first 3 months of the pandemic, we actually saw double-digit declines in our year-over-year sales volumes. But then fortunately, as the year progressed and as people began to adapt, we saw that variance narrowed to only being down by 3%. So that brings us to our current year, 21-22, where you can actually see that bar has risen dramatically. The rate application at the time was estimating our sales volumes to grow, or perhaps a better way to look at it is to recover by 5.5%. And really, if you're looking at comparing it back to 2018-19, you can see that in this current fiscal year, essentially we've recovered back to our sales volume levels back in 2018-19. When we're referring to the orange line, that represents our peak. So on the kind of the coldest day of the year where the hours are the shortest, that's typically where our peak is driven. It's also driven indirectly by our sales volumes. And so, again, starting back at 2014, you can kind of see that trend where our sales volumes are growing, our peak is growing. But then we entered into a bit of a flatlining period, which brings us to 21-22, where we hit a new peak, and in fact, we hit two new peaks on back-to-back days. So on December 29th, we hit 3,868 megawatts, and then followed up the next day at 3,910. So what we will be doing in conjunction with our mid-application update is a couple of things. So we are revisiting our load forecast to kind of reflect the better than expected growth or recovery that we saw in 21-22, and then also trying to revise based on what we're seeing around the world. So we're seeing extremely high potash prices. We're seeing $100 oil. We're going to try to incorporate some of those changes into our load forecast and revisit these numbers in time or in conjunction with the mid-application update. So I'm hoping that this slide can kind of wrap up a number of the topics that we talked about in terms of the financial impacts or the financial projections that SaskPower is looking at. We've got 6 years, again, going back to the 2018-19 actuals, but rather than kind of read you a bunch of numbers, what I thought I would do is just focus in on the third column from the right, which is our current year forecast. You can see that for this year, as at December 31st, we were forecasting a net income of $10 million. Now today's April 6th, so I think we're about 3 days into the accounting final year-end period. We're tabulating all the final year-end results, and we should have an idea in the coming weeks as to where those actual numbers are going to shake out. What we've seen so far in some of the other months since then, our fuel costs continue to be higher, just largely driven by natural gas costs. So this $10 million net income might in fact be a little bit optimistic, but we'll have a better idea in the coming weeks. So that brings us to our projections for fiscal 22-23. So just to be clear, in these projections, they do reflect the rate increases as per the rate application. So the first one being effective September 1st of 2023. And with that, we're projecting a net income of $33 million. And then again, in the following year, projecting a net income of $109 million. The final comment I would make on that is that on the very bottom row, one of the financial measures that SaskPower tracks is referred to as our return on equity. Over the last number of years, we have had a target in the range of 8.5%. So despite these rate increases, you can see that while we're making progress and getting back in line with those targets, we are still falling short. So I think with that, before we get into the rebalancing, I thought I'd open it up to any questions at this point, or we're happy to take questions at the end of the presentation. So I'll pause, see if there was anything that came in through the Facebook stream, and if not, we're happy to take questions at the end. Okay, I'll turn it over to Rod McQuarrie.
Thanks. Thank you, Scott. It is a little loose. And good afternoon, everybody. I certainly appreciate the opportunity to discuss SaskPower's rate rebalancing and design strategies for this application. It's great because these concepts are quite often some of the most challenging aspects of a rate application for customers to be able to understand and to grasp. So I always appreciate the opportunity to be able to go through it with you. So before I can talk about rate rebalancing, I first have to talk about revenue-to-revenue requirement ratios and what that means. And it's simply the criteria that we use to measure cross-subsidization in our industry. It's a commonly used metric throughout our industry. It's sometimes referred to as a revenue-to-cost ratio, but it's essentially the same thing. What it is it's the revenue that we've collected from a customer class on an annual basis divided by the total revenue required to serve that customer class on an annual basis. And it's quite often expressed as a decimal or a percentage point. But basically, if you have a revenue-to-revenue requirement ratio of 1 or 100%, it means that the class is paying its fair share. If you're below 1, you're receiving a subsidy from other classes. And if you're above 1, that class is providing a subsidy to other classes. And it's important to note that any subsidies that are provided to a particular customer or class are paid for by all other customers. So if you think of a utility's total revenue requirement as a pie, if we carve off a smaller piece of pie for somebody, then by default, everybody else has to take a little bit bigger piece of pie in order to remain whole as a utility. So the industry standard is 0.95 to 105 or 95% to 105. Utilities do this. We have this range given the fluctuations and uncertainty that are inherent in any cost of service study. So the industry consensus is that there is no material levels of cross-subsidization as long as the class ratios are falling within this bandwidth. Some utilities in Canada have a slightly larger bandwidth, 0.9 to 1.1. There's only a few of them though. Most of us are within that 95 to 105. SaskPower historically has set its rates to a much narrower bandwidth of 0.98 to 102, and that still is our long-term strategy. If you've looked at the application, you'll notice that the ratios for the 2 years of this application don't quite get to 98 to 102, but that's part of our longer-term strategy that we're taking to address some of the issues that we'll discuss later here. So rate rebalancing is essentially the process of adjusting, excuse me, of adjusting our rates so that the revenue that we collect from customers more closely aligns with the cost required to serve those customers. So rate rebalancing is very important for a utility because these ratios will deteriorate over time without regular maintenance. So in other words, the ratios will begin to diverge away because they're quite dynamic. The ratios, you don't just set them and then you're good. You set them in 1 year and then they change because a customer's revenue has changed due to shifts in their load, or their revenue requirement has changed because of shifts in costs or shifts in the way their contribution to peak, or changes in cost of service methodology. So they're quite dynamic. They're not static. They move around a lot every year. And normally during a rate application, or historically, SaskPower has always brought those ratios back into that 98 to 102 range right away in one application. With this application, we've adopted a longer-term approach to rebalancing over several applications. And we want to do this to mitigate some potential impacts to customers due to the fact that we haven't increased our rates since 2018. There's ongoing technological advancements that are affecting our industry right now. The barriers to entry for self-generation to customers are falling. Transportation, electric vehicles, electrification of heating are all changing our market and changing our industry. So we don't want to make a wholesale change only to have to potentially unbundle or undo these shortly afterwards. There has been a lack of rebalancing maintenance since 2015. And as I mentioned before, if you're not rebalancing your rates on a regular basis, the ratios will begin to diverge and they become farther apart, so it becomes more difficult to snap them back into alignment. If you do it too fast, it can cause rate shocks, so we're taking a more gradual, measured approach. And of course, we also have a shift in our rate design where we're moving to a more conventional rate design. So given these factors, we believe that utilizing more discretion within the 95 to 105 range is warranted for this application. So what does this look like? What does it actually look like when we're rebalancing? This is something that isn't traditionally shown. What we see here for the 2022-2023 rate application is the beginning ratios, each customer class and their beginning revenue to revenue requirement ratios. And every customer class receives the same increase of 4%. That's the system average increase. What you see on the column next to it is the impact adjustment of the rate rebalancing. So you can see the slight modifications to the rate, either up or down, in our attempts to get those ratios back into alignment. And then what you see is the total rate change. And this is why some customers receive a higher increase than other customers. They all get 4%, plus or minus the rebalancing impact. There's the total increase. What's really important to note is that right there is that it all comes to zero at the end. So rebalancing is revenue neutral. Rate rebalancing is revenue neutral to SaskPower. There's no additional money that's recovered from us. All we're doing is redividing the pie. We're just recutting the pie up. Some people get a little more, some people get a little less, but at the end of the day, it still comes to a 4% lift, and SaskPower remains whole right there at 100% right at the end. So as Scott mentioned before, what this means for our customers is in 2023, or the 2023 fiscal year, so these rates are effective September 1st, is that residential customers, an average residential customer will see an increase of $5 per month on their bill. Farm customers will receive an average increase of $12 per month. Oil field $61, small commercial $15, and $146 for general service. And then the next year, in the next application for rates effective April 1st, 2023, you basically see the same thing. Residentials will receive another additional $5 per month. Farm customers will receive an additional $12 per month. What's really important here is that these ratios are starting to move closer and closer into alignment with that 98 to 102. So by the second year of the application, you can see the ratios are starting to get closer together. We're not there yet, but we're narrowing that bandwidth closer and closer so that over time we'll eventually get there. Normally, we would have snapped these all back in place, the 98 to 102 in one application. Okay. So now we'll talk about rate design. We'll talk about how SaskPower's current rate structure is performing and the rationale behind it. So the pie chart on the left shows how SaskPower accounts for its costs. So 70% of our costs are what we call fixed, and 30% are variable. So fixed costs are those costs that we incur whether we produce electricity or not. So that's our plants and our poles and our wires, transformers, our infrastructure and our meters. The 30% that you see there is our fuel and some a little bit of variable OM&A or labor tied to the production of energy. So 70% of our costs are fixed whether we're generating electricity or not. However, on the revenue side, how we recover these costs, you can see that it's almost a complete reversal of how we account for costs versus how we recover them. Only 22% of our revenue is derived from fixed components, such as the basic monthly charge or the demand charge. And 78% of our revenue is collected through the variable energy charge. So what this means is, and that's reflective of our current rate designs, that embeds a significant portion of fixed demand costs within the energy charge. So what this means is that there's a substantial amount of fixed costs that are at risk if a customer reduces their consumption due to such actions such as self-generation. And then those stranded costs then have to be absorbed by the remaining customers on the system. So of that 78%, 48% of it is fixed, but we're recovering it through a variable charge. So when the customer reduces their consumption, those costs become stranded. They have to be recovered by everybody else. So why do we need to change to a conventional rate design? The current rates, quite simply, are sending a distorted price signal to customers regarding SaskPower's true costs of providing demand and electrical services. So what's happening is the energy price that we're charging customers is overstated, the demand charge is understated. And so we want to convert to a more conventional rate design to send the proper price signal to customers who are considering self-generation. So it's important to note that SaskPower is not trying to encourage or discourage self-generation in the province. We simply want to provide the correct price signal so that customers can make informed decisions about any projects that they have under consideration. The current rates don't do that. The current rates are sending the wrong signal to the customers as to how we value our product. So the other thing is converting to a conventional rate design is common amongst most electric utilities. Now, this doesn't mean that what SaskPower is doing with its rates, we're not out on an island. There are a few utilities in Canada that are using the same methodology that we're using, but the majority of utilities across North America are implementing a conventional rate design, such as where we want to go. And a review by a third-party consultant confirms that SaskPower should revert to a conventional rate design. This also facilitates the potential for unbundling our rates in the future if necessary. We can't currently unbundle the demand charge, for example, because there's too many demand-related costs embedded in the energy charge. We have to transfer those costs back into the demand charge, and then we can unbundle the demand charge accordingly so we can give an accurate price. So what does this mean for customers? What are the impacts of moving to a conventional design? Well, quite simply, energy charges will decrease, and energy charges will decrease, demand charges will increase. So customers who are using energy less efficiently on our system will generally pay more. So if you have very sporadic loads, if you're drawing high demands relative to low volume of energy, you'll generally pay more. For those customers who are using our system very efficiently, they will generally pay less. So if you have nice, flat, steady loads on our system, you will generally pay less. It's important to note, as Scott mentioned before, that only demand-metered customers are impacted by this change. That represents 4% of our customers. Our residential customers and the majority of our farm customers are all on energy-only meters. They don't register demand, so they are not impacted by this change in methodology. And we're taking a long-term approach to this. It's expected to take several applications to complete. And that's it for me. Are there any questions? That's a lot to take in, but nobody? Okay. Thank you very much.
Thank you both to Scott and Rod for those remarks. I think you've covered a lot of bases there. If there are no other questions from the floor or online, we do have one other person who would like to make a presentation, and I'll call her forward now. Elena Young, who is an MLA from one of the Regina constituencies. I'm not sure which one now, but I'll ask her to come forward and make her comments.
Somehow misplaced my remarks in the 30 seconds since I closed my notebook.
Thank you, Mr. Chair, and thank you to the officials present for a thoroughly intimidating technical presentation that I have the privilege of following with what will be a much more high-level commentary on the application before the panel today. But I truly do appreciate the work that's gone into putting on today, as well as all of the work in the background necessary to keep power flowing in Saskatchewan and to make the good work of these applications to the rate review panels. So with that, I'll begin. Good afternoon. My name is Elena Young. I am here in my capacity as the official opposition critic for SaskPower, as well as the MLA for Regina University. And I'm here, of course, to offer some high-level comment on the submission that SaskPower has made to the rate review panel. So in my understanding, SaskPower is essentially asking for an 8% rate increase within the next calendar year. In addition, there is the shift that has been discussed, the revenue to revenue required ratios, which I understand will change rates for each class of service, with the ultimate goal of changing rates to reflect revenue to revenue required ratio of 1, being understood, of course, to only apply to customers who pay separate demand and energy charges. However, at this time where there is such uncertainty, specifically economic uncertainty, and the need for true economic recovery, industrial competitiveness, and cost of living relief, an 8% increase is not acceptable. In sum, what I'm here tonight, this afternoon, to say is that while I appreciate SaskPower is facing pressures, cost of fuel, changing emission standards, aging infrastructure, and a true need for investment in power generation, it's uneconomic and illegitimate to pass this pressure on to customers, especially in a year where SaskPower is being asked to provide $48 million in a dividend payment to the province. The customers that the corporation serves are struggling with many of these self-same pressures. There is an affordability crisis in the province, exacerbated by COVID, but one that existed prior to the pandemic. Mortgage arrears, late payment of bills, credit card debt, child poverty and hunger, food and fuel costs. Saskatchewan is unfortunately a woeful leader in these tragic indicators. So quite simply, this is not the time to raise rates. It is a time to ensure that life, business, and operations remain as affordable as possible for Saskatchewan people. And fundamentally, our crowns should work for us. This 4 and 4 or 8% increase will represent the third and fourth, I suppose, increase in power rates since 2016. I believe rates increased by 5% in 2016, and in March 2018 they increased 3.5%, I believe, after a 5% rate increase application was met with at that point, historic pushback. Then to canvass recent history, in November 2020, to be fair, rates were reduced for a single year by a flat 10% at a cost of $262 million from the General Revenue Fund. Of that, I believe $58.9 million was rebated to residential customers, $48.1 to commercial, $17.4 to farm, $42.9 to oil field, $77.7 million to power class, and $17.7 to reseller classes. Of course, the cities of Saskatoon and Swift Current, who in turn pass that rebate on to their customers. As we know, this rebate ended November 2021, and in essence, Saskatchewan people received a small temporary rebate, only to now in turn be asked for it back in perpetuity some 3 months later. But to the here and now, SaskPower is requesting this increase of 4% in September and an additional 4% in April of 2023. By my math, which I suggest you check, this will represent an 18% increase in power rates since 2016. Back in 2018, the rate review panel at that point indicated that 5% was too steep, citing concerns with impacts on individuals and businesses, and noting that the trend line, and I quote here, the trend line was up. This increase, even over the course of 6 years, is significant for all classes of customers, especially during a period of critical economic recovery. And this awareness does exist even within government. On Monday, we met for the Standing Committee of the Economy, and the Minister for Trade and Export spoke extensively on Saskatchewan's capital investments and the tax incentives being utilized to attract and secure them. Now, tax credits can be very successful economic tools, but while the Hansard is not yet up, but I would be happy to provide it, it was cited that these incentives weren't optional, but necessary to secure investment due to Saskatchewan's uncompetitive power rates. You know, and we had SaskPower estimates last night as well, and again, that the Hansard is not up yet for the Committee on Crown and Central Agencies, but there was a discussion of the rising fuel costs and power purchase agreements and independent power producers and the ongoing challenges associated with those increased costs. And my recollection, which may be corrected by the record, was that officials spoke to, or the minister spoke to, choices of purchasing power at higher costs from some of these independent power producers by choice, to assist in supporting new power generators, not necessarily pursuing just the lowest cost of power. And while we certainly need an all-of-the approach to power generation, citing increased costs, especially if some of them are paid by choice, is not necessarily a good enough reason to raise rates on families and customers by 8% in the next calendar year. Now, as we're all aware, the provincial government ran the largest deficit in the history of our province over the 2020-2021 fiscal year, and you know, under summary financial reporting system that was adopted by the provincial government in 2014, Crown Corporation revenues are treated as income on the province's books, and you know, when we look at this, higher rates may mean for power, you know, higher revenues, a larger dividend, and this in turn leads to potentially larger revenues for the province. Contributions from Crown corporations may be politically and certainly economically expedient for a government facing a historic level of debt and deficit. However, SaskPower should be obligated to consider the economic realities of the province and its customers. And while for many, the $5 a month may not be the end of the world, families are facing rising costs across the board, whether it's the cost of gas, the cost of food, housing, shelter, and these small additions add up. You know, in sum, I don't believe there's a justification for raising these rates when this year $48 million is being taken as a dividend, despite SaskPower projecting in their numbers that a $28 million loss would occur in 2022-2023 should they not acquire this 8% rate increase. So the bottom line is that SaskPower is being challenged. And certainly some of the spending choices that have occurred over the past decade are a bit of an albatross, and federal regulations will mean that choices will have to be made, but a Crown Corporation that is dedicated to providing steady, reliable, and affordable power to the province of Saskatchewan. Many of these challenges that I understand the utility is seeking to address have been created by an over-reliance on economic power purchase agreements, past misspending, stranded assets, and the overutilization of dividend payments to CIC. So without a freeze on these dividend payouts and responsible generation planning, the debt of SaskPower in the province could balloon with potential, albeit very high-end cost estimate provided by the Minister for SaskPower for SMRs, which the province is potentially pursuing at a cost of $5 billion a unit. The 4 SMRs being discussed by the Minister could double the government's net debt and undermine the cost of electricity to levels that will undermine the economy and families. Now, I know there have been many submissions from organizations and a few from individuals, many representing different customer classes and interests, and some of them quite extensive, and I have been enjoying reading them, and I know the panel will take them into consideration. But in sum, at this time, Saskatchewan people are facing an affordability crisis. By this government's own numbers, inflation is up 3.6%, food costs are skyrocketing, phone, natural gas, filling your tank, PST, they're all through the roof. And by CFIB's count, 2/3 of small businesses are still struggling to recover. Saskatchewan families and customers simply cannot bear an 8% rate increase in this next calendar year. So in closing, I would urge the panel to reject this 4 and 4, this 8% increase in rates, and recommend to Cabinet the following: that SaskPower freeze rates for Saskatchewan people who cannot at this time afford these additional costs, and that a moratorium be placed on SaskPower dividend payments regardless of year-to-year profitability until the challenges facing Saskatchewan's power generation, transmission, and distribution are addressed. Thank you.
Thank you very much for that presentation. Does anybody have any questions from the floor? I don't think we have any coming in through the Facebook feed, but no? Well, with that, I'll close off. Again, I would like to thank everybody for coming out and participating. It's good to see people here on an evening or an afternoon when they could be home enjoying a spring evening. Just a few words about the panel's role and how this public meeting will be used by the panel. First of all, the panel is directed by an order of the Minister in charge of the Crown Investments Corporation and SaskPower to do a review of the rate application that's been put forward by SaskPower. Although there are several terms in the document, basically we are to provide the Minister with our opinion on the fairness of the proposed rate application under a number of criteria, including the interests of SaskPower, the public, and its customers. We also must consider the relevant industry standards, as well as the proposed rates from a competitiveness point of view with our neighboring jurisdictions. Part of our mandate is to seek input from the public and from stakeholders in general, and we have done so by asking the public to comment through our website, through emails, by phone messages, and we have been receiving some information and comments through these sources. Our plan is to complete our review taking into account all of the responses as well as the presentations tonight. I can also tell you that we had a presentation yesterday from one of the major customers of SaskPower, and that presentation in some format will be posted to our website as well. There is a deadline that we have set for public comment, which I believe is early May, so you do have some time yet if you want to make comments to us. that we will take into account. We will be working from now until June sometime to come up with our report to the minister, and we will be presenting our final report as it is scheduled at the moment on July 11th. In the meantime, you can certainly go to our website, which is saskratereview.ca, to monitor all the questions that have been posed to SaskPower and ultimately their responses. Again, thank you for coming out this afternoon, and please have a safe drive home. Thank you.